Inflation affects almost everything you buy, including groceries, gas prices, and even clothing. Do you want to know one of the best ways to protect yourself from inflation? Are you constantly worrying if you're doing the right or wrong things to prepare your investments against this so-called hyperinflation? So ever since the economic downturn caused by the pandemic, inflation has been a hot topic. So let's start by discussing, what is inflation? I'm Tony from Wealthfront, and today we're going to discuss inflation and how that impacts your investments. Inflation is the increase in prices of goods and services. Unfortunately, inflation tends to rise quicker than wages, which means that for most people, inflation makes your money less and less valuable over time. This means that the value of a dollar is worth more to you today than in the future. Now, inflation is measured by something called the CPI, or Consumer Price Index. The CPI is an imaginary basket of consumer products. Think of things like eggs, milk, clothes, all those standard things. Each month, the federal government adds up all the goods in the basket and measures how much the price of the basket has gone up or down since the last month. And voila, out comes an inflation rate. However, inflation isn't necessarily a bad thing. Economists generally agree that around 2% per year is a sign of a healthy economy. So as a result, the Federal Reserve, which is the central bank here in the US, targets an average inflation rate of 2% over the long term. And while inflation rates may fluctuate from year to year, it's an important thing to remember that this is a target, and it's an average rate of 2% per year. There's no need to panic if there are higher or lower rates, because as long as we average 2% over the long term, we meet the Federal Reserve's goal. Okay, so with inflation fundamentals out of the way, let's take a look at how you, as an investor, can do your best to protect yourself from inflation. The first step you can take to protect yourself from inflation is avoid holding too much cash. While it's a good idea to keep about 3 to 6 months worth of living expenses in cash in an emergency fund, holding a lot of money in cash means your money will likely lose purchasing power over the long term, considering how low rates can get during times of inflation. A good way to help keep your purchasing power up with inflation is to invest. While investing does involve taking market risk, the longer your investing time horizon, the more risk you might feel comfortable taking on. As our Chief Investment Officer at Wealthfront, Bert Malkiel, says, portfolios that contain large amounts of equities have historically performed well during periods of inflation. And while equities, which include stocks or ETFs, mutual funds, and more, can make your portfolio much more volatile in the short term, in the long run, you can potentially help protect your portfolio from inflation through these securities. While investing is a great way to protect yourself from inflation, it's also important to understand that with investing, what feels right is often wrong. In periods of high inflation, you might hear people encouraging you to invest in tangible assets like real estate or precious metals. While it's tempting to rethink your entire investment strategy, staying the course with your existing long-term investment strategy will usually be the best in the long term. And so remember, when you try to buy real estate or precious metals to hedge against inflation, you're just trying to time the market. And while market timing can certainly feel like the right thing, research has proven time and time again that people get it wrong. Buying and selling investments to try and get ahead of inflation will likely do more harm than good for you. So to recap, if you're concerned about inflation, I encourage you to focus on investing for the long term. Focus on what you can control. You can control things like lowering your taxes, lowering your fees, and managing your risk by diversifying and periodically rebalancing your investments. If your investment portfolio is designed to weather long-term market conditions and you're not sitting on a bunch of cash, you're well hedged against inflation risk. This is Tony from Wealthfront. We'll see you soon.